What's up guys, welcome back to the Daily Stock Picks, and in this video we'll be going over this article to see whether Facebook stock is a buy right now at its current valuations according to this article by Investors Place. So what I'll be doing for you guys today is I'll be reading over this article with my beautiful voice, commenting, and we'll be conducting my own quantitative analysis to see whether Facebook stock either belongs in our dividend portfolio or value portfolio by using this checklist. So if you guys feel like being amazing and awesome, make sure that you smash the like button for the YouTube algorithm. I would really appreciate it. And now, without a further ado, let's get this video started. So keep buying Facebook stock on the dip for the foreseeable future. Look to buy any dips in overbought shares of this social media giant. By Ian Cooper. When I last weighed in on Facebook, I said, the run is far from over. After a brief pullback, I strongly believe Facebook stock could rally to $250 by year's end. That was on February 19th as Facebook stock traded at $216.11. Nowadays, it's up to $296.34, far better than our targeted price of $250. Long term, I think we're looking at $1 trillion stock around $340 a share. Near term, I believe Facebook could move lower after becoming a bit overbought. At the moment, Facebook trades just above its upper Bollinger Band with RSI, MACD, and Williams percentage R. These are like technical indicators, which I'm not that aware of, all deep in overbought territory. Each time you've seen a similar set up going back to early 2019, the Facebook stock has pulled back. That's likely to happen again. In short, it may be the best to wait to buy on the next pullback. A closer look at Facebook stock. Long-term analysts see bigger picture upside too. Cowen analysts, for example, just set a price target of $330 on Facebook stock on the company's exposure to a multi-billion-dollar e-commerce boom. After all, far more consumers are opting to shop online to avoid the public. Even analysts at Webull will tell you consumers won't go back to physical store shopping as they did before. I like to call quite a bit, but I think actually you can trade further upside here in Facebook, said Jolla Financial President Quint Tartaro. I mean, it's not an overly high Momo stock, really, until today, quite honestly, but I think this is on its way to a $1 trillion market cap club. Ascent Wealth Partners Todd Gordon also says Facebook is still a strong company as one of the dominant players of the social media spaces. Facebook is the go-to for small business advertising dollars. There's really nowhere else to go. UBS analyst Eric Sheridan just assigned a price tag of $330 a share from $242 on the heels of Facebook Shop, which will let users buy products. The e-commerce boom could fuel big upside. Earlier this year, Facebook partnered with Shopify to launch Facebook Shops. Shopify powers more than 1 million businesses that are transforming the direct-to-consumer landscape and changing the way we shop. With Facebook Shops, we're bringing the tech industry together to help entrepreneurs succeed at a critical time, said Toby Lutke, CEO of Shopify. Lutke also went on to say that the partnership would make it easier for people to become entrepreneurs. Facebook also teamed up with Big Commerce Holdings to launch a new feature on Instagram that would allow users to shop for products. Both could make Facebook a powerful force in e-commerce next to Amazon. It's tough to argue against Facebook long term. Even with congressional antitrust investigation and advertising boycotts, nothing can stand in the way of Facebook growth. In the late 2020, the company posted second quarter net income of $5.18 billion or $1.80 a share as compared to $2.62 or 91 cents year over year. Revenue was up $18.69 billion from $16.89 billion year over year. Meanwhile, the analysts were looking for $1.39 earnings per share on sales of $17.34 billion. Better, Facebook now has 2.7 billion monthly users, which is above the estimated of 2.63 billion users. Facebook has more than 9 million advertisers on the platform, and in second quarter, the company's top 100 advertisers accounted to 16% of its revenue, which is lower percentage from a year ago, CFO David Vayner said. The bottom line is on Facebook stock. At the moment, shares of Facebook are severely overbought and could pull back near term. I also use any dips as buying opportunity. Longer term, Facebook could easily become a $1 trillion company with exposure to a growing audience, sizable momentum, and a multi-billion-dollar e-commerce boom. So let's have a look at Facebook stock by putting in the ticker symbol FB. We can see that the price to earnings multiple is 37.69. It's not that crazy when compared to the S&P 500 index, but it does seem to be a little bit on the expensive side when compared to the average index there. I like to look at Y charts for this information so that we can get a pictorial representation of the financial data in the financial statements. So looking at this, we can see that Facebook doesn't pay out any dividends. As a result, it cannot be a part of our portfolio because it's totally based upon dividend as the core concept. If you want, you can check out the other videos where we would be discussing about both the portfolios and going over the articles, right? So make sure that you subscribe down below. Turn on the bell notification icon as well if you can. Now, looking at the Facebook chart, let's see if it meets the value prospects. So in order for a company to meet my value portfolio, it needs to meet 5 guidelines or 5 rules basically. And these 5 rules are based on these books that I read. The New Buffettology by Mary Buffett and David Clark. Mary Buffett is the daughter-in-law of Warren Buffett. I don't think she is anymore currently. And the next book is Rule Number 1 by Phil Town. And the third book is The Little Book That Still Beats the Market by Joel Greenblatt, where he goes over his infamous magic formula. And the 5 rules are as follows. So the rule number 1 is that the return on invested capital must be greater than or equal to 10%. So I put a star right besides it is because I might look into companies which are lesser than this, but never negative though, that's to be sure. If they have a really good strong fundamentals and the future prospects to it. I mean, you will know it when you come across those companies, right? And rule number 2 is that it needs to have a consistent net cash flows so that we can predict the cash flows to a certain extent, at least for 10 years from now. And the third rule is that it needs to have a strong balance sheet. Many investors generally like to look at the debt to earnings ratio, debt to equity, but I believe that it doesn't give a true representation of the financial obligations for a company. So I like to look at the long-term debt, which is basically the debt that the company owes to other third parties. And a good rule of thumb is we want to be making sure that the company can clear it off within 6 years or less than 6 years. The lower, the better here, right? And rule number 4 and rule number 5 are our buy criteria. So according to rule number 4, we'll only be buying the stock when the fair price is at least at a 20% markdown from the fair price. That is the current price, right? If the current price is at least 20% lesser than the fair price, so that we're getting at least a small cushion, right? And if rule number 4 doesn't satisfy, we can look at investing in the company from a value perspective based on the price to earnings ratio. In order for it to meet this criteria, the price to earnings ratio of the company should be lesser than the S&P 500 index, or at least near equal to the S&P 500 index. And the 5-year price to earnings ratio should be at least 50% from its current price to earnings ratio, or the current price to earnings ratio should be at least 50% of the highest price to earnings ratio over the past 5 years. Then we would be considered buying this company as a value portfolio. And coming to this, we can see that the return on invested capital for Apple is 19.88%. So definitely the return on invested capital is more than 10. And the lowest that I could find was back in 2012 when it was 0.52. But right after that, I think it was just maybe a glitch or something in a single year that happened. But apart from that, it has been consistently above 10%. So definitely a good. The revenues, look at this trajectory. It's almost like a straight line, linear, right? And the free cash flows, we can see that Facebook 10 years from now had $405 million in terms of its free cash flows, and now it has around $21.21 billion. Let's see how it has been growing. So there's like a small shortcut to it. We need to calculate how many times $405 million has doubled. So double that, it's 1800. Yep, 1800 double that. Sorry, 400 double. Just for simplicity, let's assume it's $500 million for easy sake, right? So 500 double is 1,000. That's $1 billion. 1 double is 2. 2 double is 4. 4 double is 8. 8 double is 16. 16 double is 32. So around 5 double. So it would be around 50% year over year compounding annual growth rate in terms of its free cash flows over the past 10 years. That's just a rough estimate. So 50% growth is just bananas, guys. So the net cash flows, definitely a positive number, and the balance sheet that we're looking for needs to be pretty strong. So the total long-term debt that we can see here is 0. So it has no financial obligation that it owes to other third parties. And the current assets is the most liquid assets that can be converted into cash within the coming 12 months. And it has around $68 billion, and the company can use this current assets to make acquisitions, or like reinvest it into the company, buy back shares, which will be ultimately beneficial for the shareholders of the business or the owners of the company. So definitely a strong balance sheet. Now let's calculate the intrinsic value. So the current earnings per share is $18.19 on a trailing 12-month basis. Now let's see at what range the price to earnings ratio for Facebook has been trading, right? So looking at this range, we can see that it was trading somewhere around 17.32 times the earnings to 110.11. So the average would be 63.72. And the analysts are estimating that Facebook can grow at somewhere around 17.05%. Now, what we're doing with this calculation or this spreadsheet is we're taking this estimate of $8 per share, projecting it into the future by multiplying the analyst estimates growth rate year over year for the next 10 years. And then we'll get at some figure. Let's just call it ABC. That ABC figure, in order to get that current price, we need to multiply it with the price to earnings ratio. So there's two ways of looking at this. You can either consider the price to earnings ratio of the average one of the last 5 years, or otherwise you can multiply the analyst estimates times 2, and we need to consider the minimum one so that we're conservative on our estimate. So we'll be considering 34.1 rather than the price to earnings ratio of the past 5 years average. And considering that, we can see that the company might be trading somewhere around $1,150 10 years from now. That is the future price, right? Now let's find out what's the price that we need to pay right now so that we can get a suitable rate of return. My rate of return is 15%. And as per that calculation, you should be buying the stock when the price reaches $327.42. As Warren Buffett and Charlie Munger has said, we should never buy the company at its fair value. We need to be buying this company at a suitable margin of safety, because we never know what the future might entail, right? It might lose a market dominance in India because Facebook has largest market dominance in India, I think followed by Asia and then the United States. So it's no longer an US company in terms of its business model, right? So looking at that, we should buy the company only when it is at a markdown of at least 20%. So here we should, according to this calculator, we can see that we should be buying this company when it's at around $261 a share, right? $261 per share. Let's see if it did come down to this particular range anytime soon. So in March, at the peak of the currency VBD situation, we could see that the company was trading at around $160.98. So that would have been a perfect time for us to buy. We never know what the future might entail. It might come down to this level, it might not. We might need to do the recalculation, but the ideal price at which you should be buying the stock, it was at a 50% markdown, right? At a 50% discount from its fair price if you were to consider those growth rates. Looking at that, I would say that we would still hold on to it, like wait for the price to drop and then buy into Facebook. Facebook, excellent company, strong fundamentals, phenomenal balance sheet, but wait currently. That's my analysis of Facebook stock. And the closing remarks is that Ian Cooper, an investorplace.com contributor, has been analyzing stocks and options for web-based advisories since 1999. As of this writing, Ian Cooper did not hold a position in any of the aforementioned securities. Okay, so he doesn't hold Facebook stock, but nonetheless, it is a buy, but you should be holding onto it until it reaches this particular price range, and then you should consider buying the stock. So it's a wait criteria for us, right? And if you guys have stayed around and are watching this part of the video, thank you so much, guys. I really do appreciate it. And full disclosure, so this video is for your education and your entertainment purposes only. There is no guarantee that you will earn any money using the techniques and ideas mentioned in this video. This is not a financial advice. Please consult your financial or tax professional prior to making an investment in these companies. And if you like these kind of videos and derive value from it, and if it has helped you in your investment research, make sure that you subscribe and turn on the bell notification icon, guys, so that you can get notified as soon as I post new videos on this channel. So catch you in the next video. Peace.